Well, on to our spotlight then for this evening. The Fed Rates Setting Committee, the FOMC, is expected to stand pat on rates as a two-day meeting comes to a close later today. In fact, a statement will be released at about 11:30 p.m. tonight. Despite today's status quo, many watchers see high odds of a rate hike at the September meeting. The labor market is back to full employment. Inflation readings are firming up. Growth is poised to be about 2.5% on average between the second and the fourth quarter. And strains in the credit markets have eased. So the ducks are lined up, as they say, but the immediate market tumult following the post-Brexit vote and the rising uncertainty surrounding the global economy outlook have kept the Fed in a watch and wait mode. Tonight's statement will not contain updates to macro forecasts. In fact, she won't even be holding a press conference. Here's CNBC's Steve Leisman giving us all that is expected.
Big changes in the CNBC Fed survey for July. Let's get right to it. In the prior survey in June, the street was looking for the next rate hike to come in September. That's now plus 3 months. The next rate hike now seen in December 2016. And now, when will the Fed allow that big $4 trillion balance sheet to decline? Had been expected May 2017. Now it's sometime afterwards. When will the Fed finally stop hiking interest rates? It had been thought the fourth quarter of 2018. Same now, but look at where they think the Fed's going to stop. Had been 2.6%. Now it's just 2.4%. So lower interest rates for longer for next year. The street just looking for a 1.2% Fed funds rate, up from the current 0.37. Now looking at the stock market, you can see the street seems to believe that most of the gains are already built in. A big comeback from where we were, that the concern about the economy and recession in January is giving way to better stocks. But looking for the outlook for 2016, most of the gains already thought to be built in. Only a 4% gain in stocks envisioned through 2017. But taking a look at interest rates, they continue to bring down the expected interest rate of the 10-year yield, currently trading around 1.6%, seen only rising to 1.8% next year and 2.25% in 2017. All of that comes with the same 2% or a little bit better growth that we've had over the past several years since the expansion began. The outlook for GDP next year, this year, just 2%, rising to 2.25% in 2017. That's the expectation among our 43 respondents, who include economists, fund managers, and analysts. For inflation, 1.6% this year, rising a bit to 2% in 2017. Some big changes in the expectations for the presidential election. For the last 2 months, the survey's shown an 80% belief that Hillary Clinton would win the White House in November. That's now fallen to 52%. Donald Trump, he's up a bit. Had thought 15% had thought he could win the election in November. Now that's just up to 26%. But a big change you can see right there is the don't knows, up from 5% to 21%.
And as we await the U.S. Fed's announcement, let's really have a look at what possibly could happen on that. I'm now joined by Manish Singh. He's a strategist and head of investments at Crossbridge Capital London. Manish, thanks very much for joining us here on the big picture. You know, it's virtually a certain that that she will not be hiking rates. But the question now is that when will she hike rates? Will it be December, or can it be as early as September? Where do you stand?
Right. So my view is that, probably she will go in December. And the reason I say that, because recently IMF published its updated GDP report, and they have brought down the growth expectation again. And also you have to remember that we are seeing signs of stimulus in Japan, and probably we'll see something in UK as well. So all these will keep a dollar bid, i.e. dollar slightly stronger. So really Janet Yellen does not have any grounds to run away and raise rates, because that is just going to make things bad for the U.S. economy. And also, if you look at the growth expectation in U.S., it is probably going to be around 2%. Inflation expectations are not very high. 10-year yield, which is a great indicator of nominal growth, i.e. real GDP plus inflation, is still at 1.6%. So there is no real case for Fed to worry that they have any inflation concerns that they should have to take care of, and that is the only time you will see Fed really move. So I still believe that probably we are going to see one rate hike this year, and that comes in December.
So, how were we to look into the employment data so far? Because clearly that is one of the key determinants in terms of how she responds. Because if we look at the pace of hiring, that has reduced this year. So between the months of May, June, and July, at least April, May, June, we've seen on an average 147,000 jobs being created. This is actually down from 196,000 in the period from January, February, March. But at the same time, when we look at the month of June, it's seen the highest payroll growth in 8 months. So one would assume that it's giving a mixed signals. How would you read this data?
Right. So in U.S., basically, U.S. has to really create only 85,000 jobs per month for the unemployment rate to remain stable, and it is doing twice that clip, 150,000 or 160,000 if you take an average. What that tells you, and despite this creation of job, you're not seeing an increase in the wages. So what does that tell you? That the participation ratio, the labor participation ratio that we have, which is at an all-time low, is not really indicating the amount of people who are unemployed. Now, let me give an example. If a person with a decent job in U.S., let's say, was to lose the job and benefits and takes up 2 temporary jobs to make the ends meet, that is counted as 1 job increase. Now, if you think about it, that is not really a job increase and positive for the economy. If somebody, let's say, has a salary of 150K, loses a job and gets 2 jobs worth 50K, I mean, that is seen as a 1 job increase. So your unemployment rate looks very good, but that is not the real state of the economy, because this comes into account when a business is willing to pay salary. They're not going to increase salary because they see there's demand for jobs. I mean, people are looking for jobs. So I think that the financial conditions is not very strong, and this is not carried in the numbers. And these are the things which Janet Yellen means when she says there's slack in the economy. Now, also you will remember the top line number is what we call U3. The U6 number, which takes into account temporary unemployment, or people in temporary jobs, that number is still high at 8 to 9%. So this is precisely my view, is that there's enough slack in the economy. Unless you see a fiscal response coming from U.S., which I don't see this side of election, people do not really have to worry about inflation or rate increase.
You said that you don't expect any rate hike in September. You believe that if at all a rate hike happens, it's going to happen in December. Considering the fact that the manner in which market analysts and many of, including journalists, have been dissecting every word, every syllable that, that Janet Yellen utters, do you believe that if at all she does hike the rates in December, it's going to be a non-event, much like what we saw when she did hike the rates in December 2015, because the markets will be ready for it?
That is true. I think, when you saw the last rate hike, the Fed had prepared the market that the rate hike is coming. And I think that Janet Yellen will do the same thing when she raises the rates in December. So I fully expect her to signal that, and also to signal that, she's not going to, it is not going to be like clockwork, that you have a rate hike every quarter or every month. And I think she will have to do that, and probably she will do that. So I wouldn't be worried about a rate hike if it comes in December, yes.
Let's talk a little bit about the UK, because that's where you are sitting there right now. The numbers also came out about the UK GDP, and we've seen a marginal increase in GDP, by 0.6% as against the expectations of 0.4%. One must say, sitting where I am right now, immediately in the few days after Brexit, there was a lot of panic. The financial markets reacted abruptly, but now the sense, the sense we are getting is that things are calming down since Theresa May has taken charge. Give us a ground report, Manish. How are things looking when you speak with colleagues? Has the mood changed?
Sure. So I think you have had many commentators and journalists over-interpreting what was happening in UK, because remember, we didn't have, or rather we had a government, but we didn't have a new leader for 3 weeks, and a lot of people were seeing this as a sign of anarchy and unrest, which is not true, because UK was going through its own democratic process, and within the Tory party there's a lot of ambition to become a leader, and the party was going through its motion to elect a leader, and lo and behold, in 3 weeks' time, there came a leader which came by unanimity. So I think that people are over-interpreting. The second aspect to remember is that UK has not left the EU. Because unless you trigger the Article 50, UK is still part of the EU, so everything continues as it is, as status quo. Now, when people realize that this is going to be a long, drawn-out process, and there's enough currency on the side of UK to get a good deal from EU, because it benefits both sides, people will become more sanguine, and they will start looking at this as an event which does not have drastic consequences immediately. So I would say I would be cautious to overinterpret it, the data as well. I think data could become weaker in Q3, but I would not overinterpret that either. Just like I'm not overinterpreting a good Q2 data.
Is it also because of the moderate credentials of Theresa May? You know, we knew that she was an Eurosceptic, but she was against Brexit. In fact, in one of the statements that she made a couple of days ago, she said that although the United Kingdom was leaving the EU, the UK was still very much part of Europe. So in that sense, you know, she's giving these signals. So do you think it has a lot to do with Theresa May, the individual, as opposed to some of the other extraneous factors?
Yeah, so I think the view is very clear that people who have supported Brexit and people who were for Brexit, it has got nothing to do with Europe as a whole. I mean, the view is very simple, that we dislike EU, but we like Europe. I mean, that is the point of view that Brexit has. So it is a very conciliatory tone that we want to have good relations with the EU because it benefits everyone. And also remember, even if UK was to do well because of Brexit, you wouldn't want EU to not do very well because they are your neighbors. So I think there's a lot of conciliatory view on part of Brexit. But of course, you know, during the campaign, a lot of things were said. And you are absolutely right that Theresa May is a very, I would say, sensible figurehead who is going to take everything into account. And you've already seen the comment that she has made over the last 2 weeks and her trip to Scotland, to France and to Germany, and the words that are coming out. And also, if you look at the government lawyer, the UK government lawyer, he has made it very clear that UK is not going to exercise Article 50 this year. So this is going to be a very well thought of out process, and UK is not going to rush into doing anything.
But Manish, I'm just curious, were you in the Leave camp or in the Remain camp? Quickly, before we wrap this up.
I was in the Leave camp, yes, on the Brexit camp.
Oh, you were in the Leave camp, so perhaps I'm talking to the right person. Thanks very much, Manish, for taking us through those two important developments. Of course,